I'm Charlotte McLeod with investingnews.com, and here today with me is Dr. Mark Thornton, Senior Fellow at the Mises Institute. Thank you so much for being here. Great to have you.
Oh, it's wonderful to be here with you, Charlotte. Thank you.
Really good to have you. I'm excited for this conversation. And I think that many of our audience members will probably be familiar with you already. But I was thinking, since it's our first conversation, maybe you could begin with a brief overview to your background and the work that you're doing right now.
Well, I'm a PhD academic economist. I work for the Mises Institute and have been with them virtually from the very beginning, and promoting Austrian economics through our webpage and through academic publications and popular publications. And we have one of the world's largest economic web pages. We have 5 different podcasts that I try to be as much a part of as I can be. I work with the Academic Journal. I teach at Auburn University. My research has been on markets in general, but also on the war on drugs and the work of Ludwig von Mises and a bunch of other things, including the American Civil War. So I do a lot of different things.
Clearly, you have a lot going on, and we're going to go down some of those paths today. I was hoping our audience has a strong interest in gold as well as silver, and I wanted to start there because I think it will open up different paths that we can follow. Beginning with gold, we know that the metal has been on a record-setting rise this year. Of course, we're currently in a bit of a pullback, but I'm wondering if you can tell me what you see as the key drivers there. What would you pull out for gold?
Well, I think it's important to realize that gold was money until the government took it over, gold and silver. And the reason the market established gold and silver as money thousands of years ago was because of the physical properties of those metals made them ideal for money. And the big conclusion is that they held a very stable value versus all other prices. So when we see abnormal prices for gold in terms of fiat dollars, it's all really the result of government intervening in the market, replacing gold, printing up money, endangering economic performance, extracting resources, trade wars, military actions, all of these things. I know that a lot of commentators on gold and silver, they like to fixate on corrupted markets or the Chinese or war, but really gold absorbs all of the uncertainties of the world. And when the price lets up a little bit or contracts a little bit, it's the world breathing a sigh of relief. But the general upward movement of gold prices is clearly a result of government overspending and not really caring that they're overspending, borrowing beyond belief and not really doing anything to slow it down, and then just printing up money to pay for the borrowing. So it's really runaway government spending, borrowing, inflating that's pushing these metal prices to record levels really across the board.
I'm hearing a lot of focus lately on that idea of gold's price move as a warning signal. So anything further you would add there? Because I think that's quite an interesting topic to explore for investors.
Well, I think the biggest worry is international conflict. The conflict with the Chinese, with the Russians, now with India, with the Europeans, even with our U.S. neighbors in Canada and Mexico, with the trade war. But it goes beyond that. It goes to President Biden attacking the Russians, taking their treasuries, the Europeans doing the same thing. And the trade war, the trade restricting policies is really an extension of government intervention in our economy, but it's also pushing us ever closer to military conflicts. And so I think that, and military conflict would be devastating to our economies and to the economic lives of everybody on the planet. And gold is signaling its concern about the trend of where we're going with all that. I think in everyday American life, we ignore those kind of things in order to pursue our daily activities. But gold doesn't ignore those kind of things. It has to put up with that every day. It's absorbing all of that information, and we're getting a daily report card on what our politicians are doing to us and the threats that they're imposing on us as a result of their foreign policy and their imperial designs. And of course, China has very similar designs. They see themselves as a world economic power, deserving of a status. And countries around the world each have their own objectives. And if we forget that and then we try to have our way as far as the United States is concerned, I'm an American. And I'm very concerned about our own foreign policy and what it might do to the global economy.
Well, I wonder if you can say a little bit more about that, because people are very focused on the US and what happens internally there and how it can impact global markets. So what would you add there?
Well, I think to add, one of the problems I foresee is I don't see the U.S. economy as healthy as, for example, the unemployment rate reports or GDP reports or the stock market reports. One of the things that Austrian economics teaches us is that the numbers can be rigged in a certain way through the inflation process. So if they print up money, they can increase certain types of investment, advanced technology investment things that will push GDP numbers and employment numbers, electrical usage numbers ever higher, and it makes the economy seem strong. But in reality, what we know is that a majority of Americans are suffering from declining real wage rates. Their budgets are going downhill because of inflation. They're able to buy less and less. I can tell you in my hometown, the restaurants that were filled to the brim a couple of years ago are now, no reservation required. You can see that slack in the real economy right on Main Street. So I don't think the economy is very healthy. And I think that, politicians become even more aggressive, and they very often use military actions as a way of covering up for the fact that they've screwed up the economy. And I think one of the things in particular that I'm looking at is these aerial attacks on these little fishing boats off of Venezuela. And that seems like it's a prime case where politicians are setting themselves up to engage in a faux military conflict in order to support their reelection campaign on the horizon. But Venezuela is allies with China. They're allies with Russia and Cuba. If we attack them, that's going to escalate in those circles as well. So this is a very dicey situation, I think, and it's one that the American people don't really even know about or care about. They don't know anything about Venezuela. And they don't care to know about Venezuela, and they like Venezuelans just fine. We have lots of Venezuela immigrants in this country, and I love them, love their food, etc. But we don't want to get the United States in a global conflict because that would bring down the world economy.
So potentially these events unfolding internationally, distracting from what's happening in the US itself. I know from reading some of your writing that you see the US moving into a hyperinflationary scenario. So I'm wondering if you can outline, I know this is a big question, but outline how we get there from where we are right now. I know we just got those latest CPI numbers showing 3%. And of course, you've already talked about how those numbers can be fudged. So what would you lay out here?
Well, the circumstances do have to be very particular to get into a hyperinflation. It happens on a fairly regular basis, and it even happens to world-leading economies. I mean, France and Germany have suffered from hyperinflations. We had a hyperinflation in colonial America, so it's not out of the question. It can happen and mostly around wars, though, and that's why I bring that up. I told you I don't predict gold prices and things like that, but one of the first presentations I ever gave, they asked me to comment on these other predictions, and I said, well, ultimately, the price of gold in terms of fiat dollars is going to go to infinity whenever we get into a hyperinflation. And what that takes to engineer a hyperinflation is, of course, large-scale government spending, large-scale government borrowing, a huge national debt which cannot be paid, and then, of course, the politicians continue to print in order to finance the deficit. And, of course, the United States is running a multi-trillion dollar deficit, and the interest payments are already $1 trillion a year. It's one of the biggest budget items, and it's scaled to go much higher in the future, especially if interest rates goes up, which is related to what people think about the dollar and its rate of depreciation. And we have just going through a year in which the dollar is depreciated considerably in terms of double digits against the other fiat currencies. So we've got to be concerned about that. If the United States was to go into war and having to spend a lot of money on military armaments, to devote a lot of the labor force into the military, the economy would shrink, the government would grow, and the need to finance that with printing would be enormous. And of course, if that resulted in a loss in the people's perception about the future of the dollar, then they would start dumping dollars into the American economy, and that would further exacerbate the decline in the value of the dollar, the rise in global commodity prices, oil, metals, grains, etc., and the inflation would proliferate into American life, and we would look back on 3% as the good old days relative to what we might get under that type of scenario. And then once we get into that scenario, then you have to depend on politicians seeing the light and realizing what they've done and asking for forgiveness and reforming the economy. But that is very difficult. That almost never happens except during periods and acts of great desperation on the part of politicians. So it's a lot of trouble and enormous uncertainty that could be revealed to us in the months and years going forward.
Definitely, I can see the way you lay it out there. So this could happen, not guaranteed to happen. You mentioned this needs a quite particular set of circumstances. And I know earlier this year there was, I don't know if optimism is the right word, but there were some conversations around Doge and Elon Musk coming in. Maybe they're going to clean things up. That seems to have fizzled at this point. But do you see a scenario where we get something a little bit more optimistic?
Well, yes. And, the Doge thing, there was never any promises. There was never any consensus. Elon Musk and his team never had really much in the way of authority. And as a matter of fact, their authority was questioned right and left and still is being questioned in the courts today. So there wasn't much punch behind that. But we have had periods where we've gotten into inflation in the 70s and other periods, and the U.S. Has made more formal declarations. They've passed legislation. They brought in Paul Volcker in the late 1970s, and they made what appeared to be a good faith effort to at least cut back or reform the system, and the value of the dollar strengthened as a result. So if the politicians commit to sounder money and make a legislative commitment if they commit to balancing the budget or, reducing the deficit in some formal way, that would really throw the brakes on the precious metal markets and strengthen the value of the dollar, probably reduce interest rates and spur real economic growth. Because if the money's not going to the government, it can go to the economy, it can go into small business. They can buy capital and computers and productivity enhancing devices so that Americans can be more productive and more competitive on the international economy and on the international scale. And so you can get periods of improvement, and we have experienced probably 3 or 4 bouts of that reform-mindedness. I mean, not reform-mindedness enough to bring us back to the gold standard, but at least good talking points and in some cases legislation or personnel changes at the Fed, things of that nature. So yes.
I think it's good to look at the flip side, especially because when people look at what's happening today, I think a lot of the time they wonder, all right, is this similar to another time in the past? Any other time periods that you would say remind you of what we're seeing right now?
Wow. Well, no, I think I'm thinking of the current situation as more of an unprecedented place, but I think we could be, the stagflation of the 1970s. It has a lot of parallels. At the Fed, for example, in the 1970s, they didn't believe that the money supply was responsible for higher prices in the economy. And the current Fed doesn't believe that their own policies of printing money are responsible for increased prices. And there were some very dovish people appointed to the Fed in the 1970s who allowed politicians to strong arm them into dovish low interest rate policies. And today, we have President Trump and President Obama and President Biden. They were all appointing more dovish people to the Fed, to the point where Jerome Powell, who was a dove, it was considered a war hawk on inflation. So yes, I mean, in that sense, there's a direct parallel, and we have really been feeling the effects of this for years now, where the adverse effects of inflation are really harming middle-class America. The Fed and the money printing, it causes higher prices, it causes the business cycle, it causes the booms and busts, but it also causes a artificial redistribution of income and wealth from the middle class to the upper high-income, high-wealth individuals who can really benefit from those artificially low interest rates, because artificially low interest rates push asset prices much higher. So stocks and bonds go up with aggressive Fed policy. And so the wealthiest in society benefit, but the working class, whose companies can't afford new tools and computers and productivity enhancing devices, their wages stagnate, and then they lose purchasing power from price inflation. So we're definitely experiencing that. 50-60% of American families right now are seeing declining purchasing power of their income. So I'm talking about people who are working full-time, maybe working 2-3 part-time jobs. So we're talking about working people, and they're falling behind. They can't pay their bills. They're running up credit cards, and and they're being hurt, they're being harmed, and they don't know why. And they're having to explain to their family why they can no longer afford, this type of cable bill or this kind of internet system, or they can't get new phones, or, we're going to have to do with less, or we're not getting a new car this year. All of those decisions which were built into the family budget, now cannot be made because of what the Fed has been doing to us, especially since COVID, when they went ballistic with the money supply, where the government spent trillions and trillions of dollars, where they sent everybody home. So we had an unproductive economy, just fueled by the money drug, essentially.
Well, and the Fed is very timely to talk about right now because we have the meeting coming up later this week. I'm wondering what you see as the Fed's path forward. So we got an interest rate cut at the previous meeting. I know widely expected at this one is another cut, but what are you expecting to see? What commentary, and maybe if we look further into the future beyond 2025, what are you expecting?
Well, the Fed is a game of confidence. They have one tool, they have one policy, they can print money. And so they want everybody to believe that they are not responsible for higher prices, that they will come to the rescue if the economy needs saving, but they're ultimately doing the job of undermining the productivity of the economy every day. And I do expect them to cut interest rates, but of course, what have we been told? We've been told the Fed is data dependent. The Fed is data dependent for years and years and years. And now that the data is not there, they're saying, well, we can do without the data for a little while. And so they plan on cutting interest rates. I suspect that policy is going to continue, and then the stock market is going to get in trouble, and they're going to go bananas on the interest rate lowering. They're going to stop tightening, their balance sheet, and they're probably going to loosen the balance sheet and start buying more assets, mortgage-backed securities, and probably long-term government bonds is the place that they're going to concentrate their effort in over the next couple of years. And then, of course, President Trump is going to replace Jay Powell as chairman. Now, Jay Powell could stay on longer past the spring of 2026. That's probably not going to happen given the amount of money that he'll be able to charge for speaking fees. But President Trump's going to replace him with another dove who's going to be even more aggressive with monetary policy. And then there's another appointment coming up after that. So, President Obama, President Biden, and now President Trump are loading up the Federal Reserve with monetary doves who will cut interest rates and expand the money supply at the drop of a hat. And so that's also of great concern to me. And I think people involved in as consumers, as purchasers, silver stackers, I think that's what's driving their behavior. I think it's driving the optimism in the suppliers of precious metals, the investors in precious metals. I'm sure everybody's concerned about the current dip in prices. We went through some severe growing pains in the last few weeks, where we went from a stable market of silver stackers and central bankers who just bought and held, and then all of a sudden the price started moving so fast that speculators and market timers and traders and speculators were all coming into the market, and we hit $50 and the whole market blew up. Everything was in disarray because of the market experiencing growing pains. And then as we busted through new record highs in all the metals, everything sort of fell apart, and people started taking profits, and now we're here. But the pullback, even though it's been severe, is a small percentage of the move up from just August of this year. So let's not forget that. And so, the buyers in this market, the participants in this market, the suppliers of these metals, I think generally have a very long run bullish attitude towards their markets moving forward. And I think they see it as a long-term proposition. and that I think most would be shrugging off the current situation. And there's been intense desire to get their hands on this metal on the part of central bankers and stackers and investors. I noticed right before airtime, I looked at, because I've actually made a couple of small purchases myself, and the American Eagles, the premium on American Eagle coins were over 20%. So that tells me that not only are consumers wanting the metals badly, but suppliers want to get their hands on more of this metal as well.
I think I see some of the same themes among our viewers, where many people are looking at this pullback in the prices as a buying opportunity, so they feel pretty good about what's happening right now. And then there is some concern among the people about, is this it? Is this the end of the run? But I think you're right. For the most part, it seems like people do think that it's going to continue. I wonder if we can talk a little bit more about silver. You shared some of your thoughts on the outlook for gold. I know when it comes to silver, you've done some work looking at the gold-silver ratio. So I'm wondering if you can share your thoughts there and what that tells us about where the silver price could go in the future.
I'm very optimistic about silver prices because it has, it's such a vital metal for productivity going forward in technology. I mean, all of the really especially important applications in electronics and technology and energy efficiency. It's just an amazing metal, even medical applications. But, with more respect to the market, of course, there's good reason why silver moves more erratically than gold. And it relates to the mining industry. Most silver mined is a byproduct of lead, zinc, gold, copper, and a bunch of other metals. In other words, there's been almost no investment for decades now in silver mines, where the primary goal is to get silver. But there has been a lot of investment, especially leading up to the housing bubble in the early 2000s. And so this market analysis dates back to that period, say 2003, 4, 5, 6, 7. You see explosions in lead prices, zinc prices, copper prices. All of those industrial metals broke out from long-term low levels that date back for years and years and years. And all of those metals moved up. And it's not just because of the United States, but it's also because of India and China and all of the emerging markets where people were building infrastructure. So if you're building buildings, you're using, tall buildings, you're using like 5,000 pounds of copper per floor. If you're using, conveyor belts and land moving equipment and, everything requires a bunch of lead and zinc, galvanized metal. And so all of those markets broke out back at that time. In other words, people were investing in lead mines, zinc mines, copper mines, and they were able to extract this extra silver. So you had the extra supply, but you hadn't gotten the demand yet from things like solar power and electric vehicles and artificial intelligence and that kind of thing. So we had the extra supply without the extra demand. And so silver prices remained low or suppressed really by this industrial metal byproduct production. And so if the economy, and this goes back to my very first comment, if the stock market crashes and the economy goes down, we go or even into a war situation or not, just a recession, and lead productions, zinc production, copper production all go down, that means that there's going to be less silver coming out of those mines. At some point, those industrial metal mining operations will either be curtailed or shut down entirely. So sources of silver, and there's not a lot of good new sources of silver coming online. I know there's a lot of new investment just recently, but so that makes me think that, if there's increased industrial demand, increased investor demand, and yet decreased industrial supply, that the price of silver has very good fundamental reasons to skyrocket right past gold prices in a relative sense. And that, therefore, I would argue that the gold-silver ratio is going to decline from over 100 to now it's around 80-something. And I expect that gold-silver ratio is going to continue to decline. And as I pointed out elsewhere, if you get into a hyperinflation, the gold-silver ratio could fall below 20 or below 15 even, which was the historical norm of the gold-silver currency ratio. So, yeah, I foresee those types of changes going forward.
Well, it makes sense how you lay it out there, and it ties into another point that I wanted to bring up. So in the scenario that you see coming, gold and silver, we can see that clearly they are places of safety. Are there any other places where investors might be able to go for safety in these times?
Well, that we have to rule out the U.S. dollar at this point, and government bonds, especially long-term bonds. I mean, I think the short-term treasuries earning 3.65% is, decent, but it means you're just treading water, and they're going to be reducing interest rates. And so that's going to be a less good place of securing your funds. I think that in addition to the precious metals, I think the price of oil right now is very low, and oil capital investment into oil and natural gas has been on the wane now for many years. In other words, the capacity to produce oil has not been added to very much. Certainly since President Trump's first term, but even before that, there was a lack of interest because of the environmental hysteria and the suppression of natural fuels in favor of, sun and wind and that kind of thing. So I think that the balance is tipping very much in favor of commodity investments rather than stock investments. And as a matter of fact, I just reviewed a book about commodity investing over the next 10 years. And silver was one of the better choices that the book had to offer. But I think, you have to be a little bit of your own expertise. You need information about particular commodities, but looking at their relative prices, I think energy has been suppressed. So that's oil, gas, coal, uranium, nuclear. All of those sources have been suppressed by the government. And now we have all this artificial intelligence and the immense infrastructure that they're building and the tremendous demands on the electrical grid that they're going to be bringing forth. So we probably would be expecting higher electric prices. So you sure as heck want to be invested against that possibility. So I think my next best choice would be the broad natural energy sources, because their prices are low, the demand is going to go up, but the capital investment in those industries, whether it's uranium or oil or natural gas or coal, have all been, I think, suppressed by government policy.
It makes a lot of sense. I think it's very fair to say that we're going to need a whole lot more energy going forward. And I think overall you've left us with a lot to think about. But before I let you go, any final thoughts that you would leave people with at this time?
Well, yeah, I mean, I think protection is very important, but knowledge is really, that's why they're coming to your show, is to get knowledge. And I think Austrian economics and our webpage, Mises.org, is a wealth of knowledge. We have a lot of podcasts, articles, videos, lectures, and so on. And right now we're giving away free copies to F.A. Hayek, the Nobel Prize-winning Austrian economist and student of Ludwig von Mises. We put together a greatest hits of his articles. It includes articles about inflation, articles about the prospects of a Bitcoin-like alternative to fiat money, and also one of his classic articles of why the worst always get on top, referring to politicians, of course. So if you put in the comments, I want Hayek's greatest hits, we'll send you the link and you can get a free copy of this book, or multiple copies, actually. It's a great place to start learning some Austrian economics. And Hayek was really the standard bearer of the Austrian school during the stagflation of the 1970s. He's the one that gave the ideological backbone to Ronald Reagan and to Margaret Thatcher. So they both attribute F.A. Hayek's work on inflation as the reason for their economic success. So there's no better place to start than this great little free book.
Well, thank you so much for sharing that and for that offer. We'll have your links in the video description so everybody can check them out. And thank you once again for coming on. This was great. I learned a lot.
Thank you. It's my pleasure.
Of course, and hope to have you back again soon. For now, I'm Charlotte McLeod with investingnews.com, and this is Dr. Mark Thornton.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.